The U.S. markets are currently closed. As of the market close on Wednesday, October 22, 2025, at 4 p.m. Eastern Time, shares of Nuburu Inc. trading on the NYSE American under the ticker symbol BURU closed the session at $0.3601 per share. This represented a staggering intraday gain of 24.34%, an increase of over 7 cents on the day. The stock experienced extreme volatility, opening at 0.3598, hitting a high of 0.4212, and briefly touching a low of 0.2961. What truly demands our attention, however, is the volume. An almost unbelievable 519 million shares changed hands. To put that in perspective, this is a company with a market capitalization of under $50 million. This wasn't just high volume, it was a full-blown shareholder stampede, suggesting a fundamental and violent disagreement in the market about what this company is and where it is going. Now, many investors, perhaps those managing their portfolios through straightforward platforms like Schwab Intelligent Portfolios or a SoFi robo-advisor, would look at a sub-dollar stock like BURU and dismiss it as speculative noise, a gamble not worth the risk. The common expectation for a stock like this, which has fallen dramatically from its post-SPAC highs, is that it's on a one-way path to delisting. The belief is that any pop is just a technical bounce, a dead cat move before the inevitable flatline. But what happened yesterday was not a random technical event. The reality is that this 24% surge, backed by that colossal volume, is a direct and forceful market reaction to a strategic pivot so aggressive it borders on a complete corporate reinvention. Nuburu is in the middle of a high-stakes attempt to transform itself from a failed niche hardware company into a diversified, international defense technology hub. And the market is finally being forced to pay attention. This isn't just a trade, it's a fight over the company's very identity. Let's dissect the recent price action because it tells a story. This isn't a stock that moves like Apple stock with steady institutional support or even Tesla stock, which trends on big product news. BURU is a news-driven creature, and the news has been coming fast. The catalyst for yesterday's explosion was a press release dropped in the morning. Nuburu announces strategic alliance with Maddox Defense for controlling interest JV to advance next-gen drone technologies. This wasn't a vague memorandum of understanding. This announcement detailed a joint venture under Italian law, specifically targeting NATO and allied customers, and, most audaciously, projecting approximately $100 million in annual revenue by the end of 2028. For a company that, according to its last reports, had trailing 12-month revenue of less than $10,000, this $100 million projection is an extraordinary claim. It forces a complete reevaluation. Traders using the Robinhood app or engaging in self-investing on SoFi Invest saw a sub-dollar stock with a $100 million revenue target and jumped on it. But this news didn't happen in a vacuum. It's the capstone on a flurry of activity. This transformation plan, as the company calls it, has been building for weeks. On October 16th, Nuburu announced it had restored its compliance with the NYSE American. This was critical. Just days earlier, on October 13th, the company had received a warning letter from the exchange for failing to properly notify them about a material announcement, the implementation of a new dual CEO structure. That news, which might have spooked investors, was quickly resolved, giving management the green light to proceed. Before that, on October 7th, Nuburu announced a binding agreement to acquire Orbit SRL, an Italian SaaS provider focused on operational resilience. And funding all of this, a public offering completed in mid-September that raised around $12 million. The reality here is a clear sequential strategy. Raise cash, fix compliance issues, and then immediately deploy that cash to acquire and partner with European, specifically Italian, defense and software companies. The expectation was a dying American laser company. The reality is an attempt to build a new European-focused defense contractor. The volume of 519 million shares is the most telling. When volume exceeds a company's entire market cap, it often means a huge portion of the float, if not the entire float, has traded hands in a single session. This is what a shareholder base reset looks like. The old holders, who were underwater and had given up, likely used this 24% spike to exit en masse. They sold to a completely new set of buyers, a mix of day traders on platforms like Interactive Brokers and speculative funds who are not buying the old story. They are buying the new story, the defense pivot story. This is a classic battleground stock. If you're looking at this on your Fidelity mobile app or through Fidelity Investments, the historical data is almost useless. The company of today is not the company of 6 months ago. This is where online investing becomes less about fundamentals and more about projecting the success of a management's new, unproven strategy. So, what did Nuburu used to be? What was the old business model that failed so spectacularly? Founded in 2015, Nuburu was a pioneer in high-power, high-brightness blue laser technology. This actually is very advanced tech. Blue lasers are much better at welding and 3D printing reflective metals like copper, gold, and aluminum, which are notoriously difficult for traditional lasers. This has massive applications in e-mobility for welding EV battery components and in consumer electronics. The technology itself was and is valuable. The problem? Commercialization. The company's financials tell a brutal story. TTM revenues of just $9,300 against a net loss of over $37 million, an EPS loss of over $2 per share. Its balance sheet was equally alarming, with a current ratio near 0, meaning it had no liquid assets to cover its short-term debts. The $12 million September offering wasn't for growth, it was for survival. The original business model, for whatever reason, failed to generate sales. This is the reality that old investors were stuck with. This brings us to the future outlook, and the tension between expectation and reality becomes the central question for any investment. The new expectation, the one that drove yesterday's 24% rally, is that Nuburu 2.0, the defense tech roll-up, will succeed where Nuburu 1.0 failed. The bull case is that the company will successfully license its core blue laser technology, which has clear applications in defense manufacturing. They will use their new, though small, war chest to acquire more revenue-generating assets like Orbit and leverage the Maddox JV to win lucrative NATO contracts, making that $100 million revenue projection a reality. In this scenario, a $0.36 stock price would look absurdly cheap. This is what the buyers of those 519 million shares are betting on. This is not a stock for your Fidelity IRAs or something a Fidelity wealth management advisor would recommend. This is pure high-risk speculation. Now, the reality check. The bear case is just as compelling. This is a Hail Mary pass from a company that was on the brink of insolvency. The risk of execution is astronomical. Can a management team that failed to sell a cutting-edge laser in the commercial market suddenly succeed at integrating multiple international acquisitions and navigating the complex world of NATO defense procurement? Furthermore, the dilution risk is severe. The $12 million raised will not be enough to fund this transformation. The Orbit acquisition involves Nuburu equity. The Maddox JV may require a $10 million contribution. This company will have to sell more stock, likely at low prices, which will dilute the very traders who just bought in. Traders using the Interactive Brokers platform for sophisticated online investment strategies might be shorting this, betting that the initial excitement will fade and the harsh reality of cash burn will set in. What we are watching is a fascinating case study. It's not a blue chip like Nvidia stock or a high-growth tech story. It's a turnaround play, and turnarounds are notoriously difficult. The question for anyone doing self-investing and looking at this is simple. Do you believe the new management and the new transformation plan? Or do you believe the old disastrous financial statements? Yesterday, the market voted overwhelmingly for the new plan, but sentiment in penny stocks can turn on a dime. This isn't a stock you buy and hold in an intelligent portfolio. It's a stock you watch with alerts set on your Fidelity trading platform or your Robinhood stock trading account.